That's always good talking to you. Let's move on then and welcome our alpha manager for the day. Rakshit Ranjan is joining us, portfolio manager at Masterless Investment Managers. Rakshit, hi, good afternoon. It's been a solid earnings season, right? Barring a couple of exceptions here or there. But your thoughts looking at the overall earnings season and what's your view now?
Yes, no, we are quite happy with the way it has panned out for our portfolio, in particular for the December quarter, where not only is the profit growth pretty robust, it's somewhere around averaging for the portfolio at around 50-55% year on year. It's the more encouraging piece is that it is supported by a very healthy revenue growth of mid-20s on average.
Okay, I think we've just lost that feed with Rakshit. We'll try and reconnect him in a bit. Markets, oh, I think we do have Rakshit back. Rakshit, please continue. We lost you after the opening line there.
Okay, sorry about that. So I'll repeat. So yes, the earnings season has been pretty encouraging for our portfolio's fundamentals. So if you look at the non-financials part of the portfolio, earnings growth has been comfortably north of 50% on average year on year, December quarter 20 versus December 19 quarter. And the more encouraging part is that it is supported by revenue growth somewhere in the mid-20s, right? For the non-financials piece, obviously numbers can be shaved off by say 5-10 percentage points at the profit level and 5% on revenue if you include the financials piece for the whole portfolio. So that's the fundamental growth. And also remember, when it comes to volume growth, revenue growth, the base quarter this time, which was the December 19 quarter, was not an abnormal quarter by any standard. It was just a normal quarter. It didn't have any headwinds because of which the base was low. So where many of our companies are reporting 25-30% volume growth or higher year on year, that's reflective of market share gains. It's not because the whole industry is growing. I mean, just to take an example, in the paint space, we have exposure. So Asian Paints and Berger reporting sort of 30% plus volume growth is not what AkzoNobel and Nerolac.
Okay, I think we are again having some issue with the feed from Rakshit. By the way, NCC is recovering now. It's had a massive rally, of course, but from the low point, there's been a bit of a recovery that we're seeing right now. MRF, by the way, is now at low point of the day, down about 7%. The other stock which is surging right now, I don't know if there's been any news or whatever, is Vodafone Idea. Just look at that stock, 8.5% higher on that stock right now, 8.3% higher is what you have at this point in time on Vodafone Idea. And the other stock which has been buzzing since yesterday is Max Financial, which is up about almost 5% right now in today's trades.
Yeah, pretty interesting reactions from several stocks actually. If you look at it, Eveready is the other one, by the way. Sharp result reaction. Numbers seemed okay, but I don't know, John, Eveready, if it's that continued overhang of what the Burmans want to do. The management, of course, came and denied that today. But that's another one that's reacting, a mid-cap that's reacting quite sharply after the numbers.
You know, stocks like Eveready, there's always this whole court issue, right? There's, you know, there's a court case going on, what's happening with the promoter holding, all of that. So that's always another issue. But let's do one thing actually. Okay, I think we have Rakshit back with us. Rakshit, sorry if there's been some problem. You know, since we're talking about some of the stocks, and I do take your point that Asian and Berger clearly have been in a league of their own. Can you say the same about, say, something like a Page Industries? Because, you know, there was a time when it used to grow much faster compared to its peers. But is it showing some signs of perhaps a bit of a slowdown? And are you looking at this investment once again?
So Page had a few challenges over the last couple of years. Started off with more macro, and then the way the firm responded to that, I think, according to us, they did a good job, barring maybe one vertical where they could have been a little better. Having said that, I don't think Page has lost market share, barring two maybe during 2019 to players like say Van Heusen and Aditya Birla Fashions in a way. Over the last 12-18 months, we've not seen market share related challenges, especially last 12 months. And now the 17% growth that they reported yesterday To begin with, it was healthy, led by volume growth as well of about 10%. Certainly, the men's innerwear didn't grow, but we're quite encouraged by the progress on the kids wear, the leisure wear, and in particular, the kids wear, leisure wear. These are categories where you don't have established, organized, large-scale competition yet, and the industry sizes are much bigger than, say, men's innerwear, women's innerwear. And hence the opportunity to grow here, even at a faster pace going forward, is much better. So we are actually quite encouraged by the improvement in fundamentals reported by Page, and I think over the next 2-3 quarters it should get better. In particular, because over the last 12-18 months, they've invested significantly in IT, in tech, to sort of improve their systems and processes and handle a much wider array of products across the length and breadth of the country. So things are moving in the right direction according to us for that company, and hence we are continuing to hold on to it.
Okay. Rakshit, I do want to ask about financials now, but I'm not going to start with the lenders. I'll actually ask you about your play on insurance, and I know HDFC Life is a pick for you folks. So what's the kind of runway ahead? I mean, what are the kind of growth projections you're baking in, and are you satisfied? Because, I mean, when we look at the premium performances on a monthly basis as that data comes in, it's been a little volatile.
Yes, I mean, in insurance, because different players have different degrees of skew to different types of products, and all products have a bit of a volatility in their industry demand. There are going to be quarterly, monthly volatility in numbers. But having said that, the thing that we like about HDFC Life and its runway for growth is that where the previous leadership model in the insurance industry used to be centered broadly around distribution, right? You have a better distribution, agents or whatever, bank assurance or some other way, you reach out to the customer better, and that's the sort of framework to win market share. That's how the industry existed. What HDFC Life has done over the last 5-6 years, started by Amitabh in his era and now continued by under Vibha, is a combination of actually 3 or 4 areas of strength. So to begin with, the product suite, it's the product basket itself, the ability to come out with more relevant products rather than just sticking to, say, a ULIP or some of the other products which might not have as healthy a runway in the very long term. Right, so that product innovation piece, the product basket is one strength of HDFC Life, unmatched vis-a-vis competition. The second bit, obviously, is the here as well with tie-ups through HDFC Bank and various other partners. They have a strength there, but more importantly, then it gets supported by tech. There's a lot of tech investment going into sort of putting systems and processes in place, which is much better than that for competition. And then finally, the softer layer aspect. I mean, what we quite like about HDFC Life compared to others is the senior management team is a lot more professionally empowered, a lot more institutionalized. It's not so much 1 or 2 people driving the strategy. The board is a lot more sort of contributing to the growth of HDFC Life. So, yeah.
Okay. Of course, you have the 2 best performing banking names, HDFC Bank and Kotak. But just for the last, just in the near, say last 1 month or so, there's been a bit of a move, right, to SBI. There's been a bit of a move to a couple of other banks, which valuation-wise appear much better compared to the big ones. Any thoughts here, Rakshit?
Yes, no, certainly. I mean, that's been a theme in the broader market, I would say, for the last 9 months. I mean, the kind of share price outperformance that quality used to see, or quality fundamentals used to see vis-a-vis relatively lower quality competitors, the kind of outperformance of quality stocks has reduced. In some cases, I would say for a period of 4-6 months, there was also underperformance. But we're not so perturbed by that, because when it comes to, let's say, looking at 18-20% loan book growth of an HDFC Bank, that too with a capital adequacy ratio touching sort of 20%, and already having provided for much more of the moratorium book compared to competitors. So when you put all of that together, right, better provisioned already, better capital adequacy ratios, higher in general asset quality, and hence the ability to actually grow your loan book in a much more healthier and qualitative manner over the next, say, 2-3 years. That's what gives us comfort. Beyond that, I mean, 1 month, 3 months.
Okay, I think we've lost that link again. But Rakshit, if you're listening to us, thanks a lot for joining us. And of course, we look forward to more conversations with you. The market, by the way, the 3 p.m. move is absolutely nothing. It's just perhaps been one of those option writers' day. If you've seen 15,150 put and perhaps 15,200 call, both now approaching almost zero. This is and on the bank Nifty, there's been a lot of put writing at 35,700, call writing at 35,800. So perhaps just between that, let's see if things change in the next 5 minutes or so. But been very, very stable in this range. We'll take a break. We'll come back and we'll get you an insight into dealing rooms in our segment T Street Chatter.
And of course, we'll get you the calls with Mitesh for the last half hour as well.